Hey everybody, morning Missouri, good evening, 11th of October 2016. Late in the evening, I'll keep it really quick. First chance I've got to talk at you today, but I figured today deserves some commentary because the Dow was down a couple hundred points. I want to start though before we get to that chart and read from yesterday's log because I think that's interesting what I said to myself yesterday and kind of what the market did today. So the Dow, this was from yesterday, finished up 80 points after being up 150 in the first hour. The VIX index, which is called the Fear Index, which tracks implied volatility in options on S&P 500's futures, it kind of hung around the flat line yesterday, even when the Dow was up or the S&P was up twice where it closed. The VIX wasn't tanking, so it tends to move opposite the market, and when it doesn't, it kind of sends a signal. And what I said yesterday is clearly it says options traders aren't feeling the optimism. It'll be interesting to see if it's not a harbinger of something to come in the short run. And then again, ironically, we had a pretty good sell-off today. Looks like Hillary Clinton has a big lead in the presidential race. That's clearly to the market's liking. The peso has been rallying very hard after Trump's rough weekend. I did see a headline yesterday that suggested that congressional Republicans aren't looking all that great in the polls. And so I wondered if, while a Hillary Clinton win, based on the trend I'm seeing in trading, is truly near-term bullish, I don't believe a Democratic majority to go with that in Congress would be viewed by traders as something that would be to their liking. So I do think if that is going to be something that develops and there's risk of that, we may see the market get a little more volatile. I don't know that that had a lot to do with what went on today. I really think it's more traders looking beyond the election and to the first Fed rate increase and expecting the market to struggle with that a little bit, at least at the get-go. But we'll see. So negative sentiment pretty much reigns, although individual investors got a little more bullish. About 28% bullishness last week versus 24% the previous week. 28% is still relatively bearish, and that's still a bullish indicator. That negative sentiment is really what I believe is, or at least I can tell you, that's why I keep expecting these dips to get bought, as this one probably will at some point. I don't know that it gets bought right away tomorrow morning, but and we'll talk about the technical indicators here in a second. But anyway, the rest of it is just talking about currencies and so on. So anyway, to the chart, this is the one-year daily chart for the S&P. You notice I had this wedge or this triangle forming, but it wasn't really sloping in any direction. So it wasn't like these upward slopes that tend to break to the downside. So you tend to break out of these before you get to the end of them. And you did, obviously, this time when we broke to the downside. Broke through what had been some pretty good resistance at 2150. So we'll see if that does kind of serve as a rubber band and pull this market back up into that previous trading range. Or are we going to get back down here between 2120 and 2150 where we lived there for 10 trading days or so? I want to introduce to you, and I think this is an introduction. I don't think I've done this with you before, but a lot of technicians like to use what we call Fibonacci retracement levels. So I go to the most recent bottom and then trace it up to the most recent top. And then, so here we have retracement. So you have this rally. They typically get retraced to some extent. Now they tend to find support first at 38%. And you notice it's been holding just barely above there. And then at 50%, which is just above that 2100 that I talked about, and then below that, about 2170 would be the 62% retracement. So these are traded pretty heavily among technicians. So you have two lines of defense right here, potentially from a technical perspective. One would be that key Fibonacci level, and just above that would be that 2150. So we'll see if we get there. I do think, I'll say it again, largely because sentiment being so bearish, a lot of folks are not in this market. And that tends to be something that buys a dip. A lot of people, I think, miss that move into all-time highs, and there's some real remorse there, and they're looking for opportunities to get back in. That 2100, I think, is going to be very important resistance if we go down and test that. So, folks, today makes sense to me. We didn't have the volatility that you typically get in September. Traders are sensitive to seasonality, so if you get a little catalyst, whether it's good economic data or Fed speak that says it's coming pretty soon. I read an analysis, a very thoughtful analysis that said that November makes great sense for the Fed to raise. I don't think that's going to happen, but I could sympathize with the logic, but maybe the market's worried about that a little bit. A Fed rate increase is not a bad thing. It actually says something positive in terms of the Fed's perspective on the economy. And I'll probably talk more in the next few weeks about an emerging economic theory, if you will, that maybe one of the problems is interest rates are too low, and we're getting the opposite. It basically sends negative signals. And for business investment, if the cost of money is so cheap, why not wait until the smoke clears a little more before we get busy? If you start pushing up on the cost of money, that might inspire some action in areas that we need a little action in terms of economic growth and getting into that next phase of the cycle. So it's going to be interesting, the fourth quarter. The setup isn't bad. The near-term technicals have been suspect, which I've been talking about, but the longer-term technicals I think are pretty inspiring. So, but the market can surprise us, and I'm sure it will as the days and weeks unfold. I'll be here to offer up my perspective. Thank you as always for watching and listening, and I'll be back very soon. Bye-bye.